Good morning. This is Ken Long from Tortoise Capital Management. It's the morning of October 10th, 2010, and I'm going to review the weekend reports very quickly to look for some different trading ideas. Page 1 of the strategy report. Market is in bull quiet conditions. That's favorable for the long side. On an annual basis, it's on 61 out of 100. So it's slightly above average, but still in the middle zone, the yellow zone. On a 10-day basis, it's got a score of 91 on a range of 0 to 100, so it is in overbought conditions, meaning that we'd like to already be long and looking to preserve profits. We're aware of the possibility for breakouts, but we're sensitive that a good part of the move over the last couple weeks has already been seen. We'd be looking for momentum plays, therefore. We could also be looking for any laggards to play catch-up, if that was the case. The next section here is a bundle of market mosaic indicators. This 60.6 that you see, the weekly RSI, is where this 61 comes from. It's in neutral condition. The price relative to the 200-day moving average, which is how we come up with the conditions of bull, sideways, or bear, it's 4.72% more than the 200-day moving average. That's what makes it bullish. What makes it green is that this is an extremely good reading looking back over the last 180 days, meaning it's more than one standard deviation better than the average of the last 180 days. So it's in bullish, and this is a relatively recent phenomenon. The slope of the 50-day moving average is positive. It's 0.53%. This is very bullish. When the slope of the 50-day moving average is positive, on average tomorrow is an up day over the last 15 years in SPY. If that's negative or flat, then on average tomorrow is slightly negative. So that adds to our sense of where the market is. ADX, a measure of trendiness, is at 23.5. It's been rising. It's still neutral. It's not a strong trend yet, but anything above 20 and rising can be seen as a improvement in the bullish tendencies. And we know it's bullish because the green line of it plus DI is greater than the red line. This 91, the 10-day NDX rating of 91, which makes it overbought, is where this 91 comes from. ATR percentage is 1.30%, which is right on the boundary of quiet. So on page 1, I'm getting a sense for general market conditions. This is my market mosaic. In page 2, we have I just am noting the positions that I'm holding in my monthly rebalancing account. I like 331 right now, and so I'm holding EPP, ILF, and Australia, EWA, for another 3 weeks. My next rebalancing will be November 1st. Looking at the market health check here, you see this. The vertical blue lines are a 10-day look back, 20-day look back, 30-day look back. The dark blue is the 200-day price below the 200-day moving average. So the boundary between white and blue is actually the 200-day moving average. I like the visual reminder. The horizontal red lines are various support levels we've seen in the last 6 months, where I'm not surprised if the market were to come down and test and find support, because it has before. Market condition is bull quiet, as you can see up here. That's our ADX reading at 23.5, and green better than red. The three black lines that form a channel are the 30-day regression line, and then is the middle line. And I'm always interested in the slope of that. And then the outside black lines are formed by the most extreme reading in that last 30 days above or below the regression line, and then that establishes the channel. That's a default setting that can't be adjusted on stock charts. But it is a handy visual reminder of the trend and the volatility of the last 30 days. I also look at the 20-day moving average. That's the green line, because that triggers things like the triple screen. The red, thin red, is the 50-day moving average, and then of course that the blue area is the right at the boundary is the 200-day. I also look at the Williams percent R10 because that helps inform me on my channeling system, and again you can see we're overbought. And the Williams percent R annual, which is near minus 20, and that tells us I need those two indicators for my favored washout pattern. That's page 2, market condition. This is the summary of the top 10 indexes from the ETF2 report. You can see they're all green on the 5-week rate of return, so we should be long and strong, and we are. That was the same posture last week where we were 100% invested, 0% cash. We're in bull quiet mode. EFA, which is the Euro Asia Index, is better than SPY, so it tells you global on a general basis is outperforming SPY. And inside the U.S., the small caps are better than the mid caps, are better than the U.S. large caps. That tells you where the strength inside the U.S. is. Small, then medium, then large. And then emerging markets in Asia less Japan are the strongest regions. Japan and U.S. large caps are the weakest regions. Just a quick benchmark check, self-explanatory. This is an additional extract of the ETF2 database that goes a little deeper into regions and sectors, and which helped me get insight for the weekly sectors of strength for the upcoming week. And what I've done is I've taken those additional ETFs like semiconductors, DBC is a commodity blend, USO is oil, and GLD is gold, and added it to the mix of the basic 10. The S&P Spider Extract, or the 9 sector spiders, you can see finance is extremely bad. Healthcare also bad, which is sort of an anomaly. I would be looking to see money starting to rotate into both of those sectors because it does periodically. Global business sector is the same set of business cycles, but it splits out telecom and utilities, whereas the XLU in the U.S. Spider contains both of those. The iShares that these are based on split those out. Quick look at the world market model. You can see the relative weakness in the U.S. This is what I'm looking for, the first thing I always look for. The U.S. large caps are weak compared to the rest of the U.S., but you can see that Asia has been very strong. Asia, less Japan, very strong. Commodities have been on a run, especially the precious metals. Latin American emerging markets have been very strong. Mexico, Brazil, and Canada with their commodity economies. That's another reason why Australia is doing well too. Europe is very strong too. So you can see between Euro Asia, that's why EFA, which is this one here, the Euro large cap, is stronger than the U.S. Finance bad in the U.S., and that's sort of an anomaly. It's much worse compared to the U.S. sectors as global finance is to the rest of its sectors. So that's sort of, I think U.S. financials is an area for a bottom feeder like me to be looking. The weakness in the dollar is reflected in the currency stack. The 100 by 200 is short finance, no surprise. Is long the defensive sectors like XLU and gold and treasuries. These are the top 30 ETFs in the database of ETF2. Silver, India, Hong Kong, more India. Emerging markets, coal, grains, South Africa. Noticing a pattern here. It's materials, commodities, Asia, everywhere you look. Now here's some Brazil as well, South Korea, gold, and more emerging markets. That's where the strength is right now. These are the top 30 ETFs based on liquidity. That's why I like small caps, because of the incredible amount of volatility. It makes them very tradable. And that's a quick look at the strategy report from the top down. You should have a number of ideas for sectors based on that. We'll look at the daily next.